Talk to us about sort of this earnings season as we push forward to a lot of the names that we're continuing to get after the bell. We've heard from about 80% in terms of market cap so far. Are you better than expected in terms of how they're coming in, or did we just set the bar really low?
Well, Taylor, I think the bar was set pretty low. And I think it wasn't so much about what the third quarter results will look like, but what the outlooks really would look like. We saw earnings estimates come down pretty hard, pretty sharply. And really what we were watching for was how companies were going to guide. We expected companies to be pretty conservative. The sources of risk right now are elevated, and they've been that way all year long. And now with interest rates higher than people expected and more work to be done to solve the inflation problem, companies are rightly saying, look, there's a lot we can't forecast right now about the next quarter. And in certain parts of the market, we have inventory buildups that need to be worked down. It's really asymmetric. Some companies are doing well. They're still facing shortages. They still have very strong demand, while others, are seeing demand just drop off a cliff. So one has to be very careful about stock selection at this point and really be positioned for, not really the next 6 months. It's going to be awfully hard to predict, but the next 1, 2, 3 years. And that's where we're finding some opportunities for clients.
JoAnne, I like the way you sort of basically tell us about this bifurcated market, the fact that some are managing to still see a glut of volume growth and indeed ability to pass on inflationary pressures. We saw that was Kellogg, but there's still the inflationary pressure and supply chain issues do hit its future margins, which are still growing. I'm interested as to who ultimately are the winners and the losers, and whether the winners can be big enough to offset the losers in terms of overall equity valuations.
Well, Caroline, it's really going to depend on, again, what kind of an investor you are. If you really just need cash flow, if you can ride out this volatility, you stick with high-quality companies with really strong dividend yields, whether that's in AbbVie, in healthcare, or there's several in consumer, there are several in even tech, like an IBM, for example. But if you're looking for longer-term appreciation, right, and you want to get through the next 6, 12 months with better chances than otherwise, you look for the places where consumers are still going to go. And whether that's a TJ Maxx or a Target as middle class or upper middle class downshift to cheaper retail opportunities, we think those are going to be very solid places to be, or you're in healthcare, in medical devices, or again, if you have the patience, you're in tech, to the stalwarts that are going to grow because their end markets are just driven higher by the changes in the way people are living and working, like a Microsoft or an Apple.
Is there a broader growth story, though, out there, JoAnne? I mean, even if we are in a recession or headed towards one, there has been a lot of discussion here about how uneven, to a certain extent, this recession might be. The idea that this isn't necessarily going to be everyone sort of being dragged down, that there will be certain sectors and certain companies that will probably thrive in a way that we didn't necessarily see during the big financial crisis or even during the 2011-2012 period.
Yeah, Romaine, I think that's exactly right. I mean, the companies that are going to continue to thrive are the ones which inexorably face further demand for their products, whether that's internet-related, cloud-related, medical. I mean, look at the demographics behind medical devices and pharmaceuticals. All right, those are going to be areas where you can, expect to see growth over multiple years. And during this recession, though, we should expect, some of the mid-range retailers, probably to face more exacerbated flight by consumers as they look to save as their budgets get tightened. But autos is an area which is continuing to have to serve a very strong market. There's just been so much pent-up demand because of the shortages there. And we are still seeing semiconductors trying to sell, whether it's Texas Instruments or NXP, trying to sell into that end market with strong quarter-over-quarter growth and obviously very strong year-over-year growth.
In conversation right now with JoAnne Feeney over at Advisors Capital, sticking with us as we count you down to these closing bells. Back to JoAnne in just 1 second, but first over to Taylor here at the board with our stock of the hour.
Lots of still quarterly earnings coming today. Starbucks, though, going to be a big one that we focus on when we think also about the global story that is underway, not even to mention some of the inflationary pressures. Starbucks is one of those. You're up about 0.4%. Some decent tailwinds within the pricing ability of a U.S. consumer. How much of that, though, is offset by some of the weakness that we get in China? That'll sort of be another sort of key bellwether that we are looking at in this earnings season. Flip up the board. JoAnne, let me bring you back in here. It's a terminal chart that I show frequently. It is break-evens, which had really come off the highs of 6 months ago, but they've started to creep up just a little bit. And you're looking at a 2-year break even that is sort of back near 3%, 2.8%. How are you thinking about if inflation does become de-anchored, and which companies are poised to be able to manage that?
You know, we're seeing a lot of the inflation pressures appear in company revenues and earnings. Obviously, prices are being built into sales. That is essentially inflation. And so some of the companies we've seen in the consumer space, for example, have been able to raise their prices, pass that on to consumers. Now, that's probably going to slow down a bit. But when you look at the break-evens, we like to look also at the five-year break-even. And that's still right around 2.3%. It's been a little bit volatile as expectations have shifted. But what that tells us is that the Fed still has a lot of credibility, that investors longer term are recognizing that the Fed is going to get this inflation situation under control, and longer term they're going to get much closer, down around 2.3% to their 2% target. And so inflation, does seem like it's certainly more persistent than expected, but it's fundamentally a temporary problem because the Fed does have the tools to bring this back under control. In the meantime, companies that have been able to pass on those price increases, like in the consumer space, look at Constellation Brands, another one that we really like right here. Beer sales are really not falling off very much. It's pretty inelastic demand.